In 2025, millions of UK workers will pay more in tax without a single rise in salary, and most won't even realise it's happening. Sounds unfair? That's because it is. From frozen tax thresholds to hidden council hikes, the system is quietly draining your wallet. One small raise could suddenly push you into a higher tax band, while the price of everyday life climbs higher from stealth taxes and shrinking allowances. Even owning a car or saving for retirement now comes with new financial traps. And these changes don't just affect the rich, they're targeting the middle class, freelancers, and even pensioners. If you think your paycheck is safe, you'll want to see what's really coming in 2025. Number 1. Income tax threshold freeze. One of the most overlooked tax changes in 2025 is the continued freeze on income tax thresholds. On the surface, nothing seems to change, no new rate, no visible increase, but this freeze quietly pulls more people into higher tax brackets, especially as wages rise with inflation. It's often called a stealth tax, and for good reason. Here's how it works. If the basic personal allowance remains at £12,570, while average wages increase, more of your income becomes taxable. And if your income crosses £50 and £270, you suddenly start paying the higher 40% tax rate, even though your real earnings haven't increased in value. That means more tax paid, less money kept, even if you feel like you're just keeping up. For someone earning around £45,000 today, a modest 5% raise in 2025 could push them closer to or past the threshold. The result? They could pay hundreds more in tax. This silent shift affects millions of workers who never imagined they'd enter the higher rate bracket. The Office for Budget Responsibility estimates the freeze could create millions of new higher rate taxpayers by 2026. While the policy was initially introduced to stabilise government revenue, it's now become a major financial pressure point for households. Unlike an obvious tax hike, this method doesn't require parliamentary approval each year, making it a politically convenient tool. But the impact on your wallet? Very real. Every raise, every promotion, even bonuses, now have a hidden price tag. It's a reminder that in 2025, doing better financially doesn't always mean you'll keep more. Number 2. National insurance changes. Another key reason you'll pay more in 2025 is due to national insurance NI changes. While NI might not grab headlines like income tax, it takes a significant chunk out of your paycheck. And recent shifts mean that chunk is getting even bigger. Starting in April 2025, the government is expected to continue adjustments to national insurance thresholds and rates to offset fiscal pressures. That includes a smaller gap between employee and employer contributions, and in some cases, higher rates for self-employed individuals. If you're earning above the primary threshold, any increase, no matter how minor, translates into real money lost monthly. For example, if the rate nudges just went higher for an average earner, bringing in $35,000 annually, that's around $350 more per year. Over 5 years, that's nearly $2,000 gone, without you ever moving up a tax bracket. For freelancers and sole traders, the effect can be even sharper. They're not only paying Class 2 and Class 4, NICs, but also facing reductions in allowances and reliefs. Add to this the cumulative effect. Your income tax goes up from frozen thresholds, and then NI kicks in heavier. It's a double financial squeeze. Most people don't notice it until it's too late, because NI is automatically deducted. You never really see the money leave, but you certainly feel the difference in take-home pay. It's a silent shift, one that affects nearly every working adult in the UK. Whether you're employed or self-employed, national insurance changes in 2025 are poised to be a major contributor to the growing cost of living. Number 3. Capital gains tax adjustments. The capital gains tax (CGT) system in the UK is changing, and in 2025, it's expected to hit investors, landlords, and even casual sellers harder than ever. The key change? A sharp reduction in the CGT annual allowance, the amount of profit you can earn from selling assets before paying tax. In 2024, the CGT allowance dropped from £6,000 to £1,000, and in 2025, it's expected to fall even further. possibly to £1,000 or less. That means if you sell shares, a second property, or even valuable items like art or antiques, you'll be taxed on almost every pound of gain. Let's say you sell some shares and make your £500 in profit. Under the old system, most of that might have been tax-free. But with the new lower threshold, nearly £4,000 could be taxed at rates of 10% or 20%, depending on your income bracket. That's an unexpected tax bill of up to £800, even for small-time investors. For landlords, the hit is even greater. Selling a buy-to-let property now means carefully calculating capital improvements, purchase costs, and more, because every pound matters when so little is exempt. And if you're already in the higher income bracket, you'll be paying 28% on gains from residential property sales. These changes are designed to raise revenue quietly without directly increasing rates. But make no mistake, they're deeply impactful. Whether you're saving for retirement or just cashing in on an investment, capital gains tax in 2025 is no longer just for the wealthy. It's something everyone with assets should be watching closely, or risk paying far more than expected. Number 4. Dividend Tax Hike. If you earn money through dividends, whether from investing in stocks or running your own company, 2025 brings more unwelcome news. The dividend tax-free allowance, which was already cut to £1,000 in 2023 and then £500 in 2024, is expected to shrink further or disappear altogether in 2025. That means more of your dividend income will be taxed, no matter how small. Let's break it down. Under current rules, basic rate taxpayers pay 8.75% on dividends over the allowance, while higher rate and additional rate taxpayers pay 33.75% and 39.35% respectively. So if you're a small investor or a business owner taking dividends instead of salary, this shift means more tax on the same income. For example, imagine earning just £2,000 in dividends, with only £500. Tax-free, the remaining £1,500 would be taxed, costing you over £130 if you're in the basic bracket, and much more if you're higher up. For company directors who pay themselves through dividends to save on income tax and NI, this change cuts directly into profits. This hits side hustlers, freelancers, and even retirees who rely on dividend-paying investments. What used to be a low-effort, tax-efficient income stream is now becoming a tax liability. Many may need to rethink their investment strategies or risk watching their returns shrink year after year. The message is clear. Whether you own shares in a tech startup or just park money in dividend-focused funds, 2025's tax rules will take a bigger slice of your earnings. And with the allowance nearly gone, no dividend earner is safe from the hike. Number 5. Council tax increases. In 2025, council tax bills across the UK are set to rise again, adding to the growing list of hidden household expenses. While it may seem like a local issue, council tax is becoming a national pressure point, affecting nearly every homeowner and renter. Many local councils are using their legal power to raise council tax by up to 5% annually without needing a referendum. Some areas are even going beyond this cap under special permissions due to budget crises. This means a Band D property, which might have paid around £2,000 in 2024, could face a bill closer to £2,100 or more in 2025, without any increase in services. For renters, the impact is often hidden in rising rent prices, as landlords pass on higher council tax costs. For homeowners, it's a direct hit to monthly budgets, and it arrives like clockwork every April. What's worse, many people are still in incorrect tax bands, meaning they may already be overpaying without knowing it. Council tax hikes are being justified as a response to rising costs for local services like rubbish collection, policing, and adult social care. But with inflation already squeezing incomes, these increases can feel especially painful, especially when local services are being cut rather than improved. One step people can take is to challenge their council tax band, a process few use, but which could save hundreds if successful. Still, for most, 2025 will mean paying more for the same or less. As the cost of living crisis deepens, council tax hikes are quietly becoming a significant burden for millions of households. Number 6. Pension tax relief adjustments. Changes to pension tax relief in 2025 are expected to quietly reduce how much of your income you can shield from taxation, especially if you're a higher earner. While pensions are often seen as a safe tax haven, new limits are making it harder to build wealth for retirement without triggering penalties. Let's start with the annual allowance, the maximum you can contribute to your pension each year while still receiving tax relief. Though it increased to £60,000 in 2023, the tapered annual allowance for higher earners significantly reduces that cap. If your total income exceeds £260,000, your allowance could drop to just £10,000. In 2025, this threshold could tighten even further, pulling more professionals into the trap. Now factor in the lifetime allowance (LTA). While the LTA charge was abolished in 2023, future reintroductions or stealth caps are being debated. If reimposed, exceeding this limit, previously just over £1 million, would mean additional tax penalties on your pension savings, even if you followed the rules. This matters because many people contributing steadily over decades, especially with employer top-ups, can unknowingly cross these thresholds. And unlike capital gains or dividends, you might not realise the tax is coming until you try to withdraw funds in retirement. If you're self-employed or a contractor relying on SIPP or private pensions, these rules make planning even more complex. One wrong move could cost thousands in lost reliefs or penalties. In 2025, pension contributions still offer valuable tax advantages, but they're no longer the guaranteed safe zone they once were. Whether you're early in your career or planning to retire soon, understanding these limits is critical to avoid unpleasant surprises later. Number 7. Inheritance tax reform. Inheritance tax, IHT, has long been viewed as a tax for the wealthy, but in 2025, that perception is shifting, and middle-income families are starting to feel the pressure. That's because property prices have soared over the past decade, while the IHT threshold has stayed frozen at £325,000 since 2009. As a result, more estates are being dragged into the tax net without any change in family wealth. When someone dies, their estate, property, savings, and assets is taxed at 40% on anything above the threshold. There is a main residence allowance of £175,000 for direct descendants, but even with this, the combined allowance often falls short for families in areas with high property values. A modest home in parts of London or the southeast could easily push an estate well over the limit. In 2025, the government is tightening rules around gifting too. Previously, gifts made 7 years before death were exempt, but new proposals could shorten this window or reduce how much is exempted, making it harder to pass on wealth early. And unlike income or capital gains tax, IHT hits at the worst possible time, during bereavement. Families may be forced to sell property or liquidate assets quickly just to pay the bill. What was once seen as a rare tax now affects more people each year due to frozen thresholds and rising asset values. If you're not actively planning, your family could face thousands in unexpected taxes. From updating wills to setting up trusts, 2025 will require a much more proactive approach to estate planning. Inheritance tax is no longer a rich person's problem. It's an issue every homeowner and saver now needs to understand. Number 8. Green taxes and vehicle-related charges. In 2025, owning a vehicle, especially an older or less efficient one, will cost more than ever, thanks to a rise in green taxes and transport-related charges. Designed to tackle climate change and improve urban air quality, these measures are having a real financial impact on everyday drivers across the UK. The most visible change is the expansion of ultra-low emission zones, ULEZ, and clean air zones, CAZ, in more cities. If your car doesn't meet modern emission standards, especially older diesel vehicles, you could be paying £12.50 per day or more just to drive in your local area. In places like London, Birmingham and Manchester, These charges are becoming permanent daily expenses for thousands of commuters. Then there's the steady rise in vehicle excise duty, VED, or road tax. In 2025, higher emission vehicles will face increased rates, while even some hybrids and newer petrol cars may lose prior tax breaks. Owners of older cars could see their annual VED jump to £600 or more, simply for keeping their car on the road. Electric vehicles, EVs, once shielded from many of these costs, will also start facing new taxes and levies. From 2025, EV owners will begin paying VAD too, ending the free ride. It's part of a broader move to replace lost fuel duty revenues as more people switch to electric. Whether you're commuting, running a business, or just doing the school run, these changes add up. What once felt like small environmental charges are becoming major financial considerations. If you drive regularly, 2025 will likely bring higher costs, more restrictions, and the need to rethink how and when you use your vehicle. Number 9. VAT on everyday goods. In 2025, value-added tax, VAT, is becoming a silent cost booster on everyday essentials. While the standard VAT rate in the UK remains at 20%, the government is gradually removing exemptions and expanding VAT into areas that were once protected, leading to higher prices for basic services and consumer goods. One key shift is in energy bills. Historically, domestic energy was taxed at a reduced rate of FOM, but there's increasing pressure to adjust this as part of wider green policy reforms. If rates rise even slightly, households could see an extra £100 and £200 per year added to already high energy bills. Another area facing quiet VAT creep is hospitality. During the pandemic, temporary VAT reductions helped businesses and consumers, but those rates have now returned to 20% and may go higher in specific sectors. Eating out, staying in hotels, or even takeaway coffee has become noticeably more expensive, partly due to tax policy changes. Then there's the digital economy. Subscriptions for streaming services, online courses, and digital tools are now being taxed more consistently, closing loopholes that previously kept costs down. What used to be £9.99 a month could now become £11.99 overnight, not from the company, but from VAT compliance. Even services like private tutoring, wellness treatments, or pet care, which were once VAT-free or discounted, are being re-evaluated. If your lifestyle includes any of these, expect the cost to rise. VAT changes often fly under the radar because they don't appear as a direct tax increase, but they affect your daily spending. In 2025, don't be surprised when the same basket of goods costs significantly more, because VAT is quietly claiming a bigger slice of your wallet. Number 10. Corporation tax rise. In 2025, the rise in corporation tax may seem like a change for big businesses, but the ripple effects will reach everyone, from employees to consumers. The main rate of corporation tax increased from 19% to 25% for companies with profits over £250,000, and even smaller businesses are feeling the squeeze through marginal relief tapering, starting from just £50,000 in profit. For business owners, this means less money retained for growth, hiring, or reinvestment. If you run a small limited company, this tax hike could eat into your post-tax profits significantly, especially if you rely on dividends to pay yourself, which are also being taxed more heavily. But here's where it affects everyone else. To preserve profit margins, many companies pass these costs on to customers. That could mean higher prices on everything from groceries to phone contracts, subscription services, or even transport fares. Over time, these small increases compound into noticeable financial strain for regular consumers. Employees aren't safe either. Businesses trying to offset their tax burden may delay salary increases, reduce bonuses, or freeze hiring altogether. In some industries, cost-cutting measures may lead to job insecurity or the end of remote work, benefits to recoup operational costs. The government argues that companies should contribute more to post-pandemic recovery, But the reality is that consumers and workers will share that burden. In a tight economy, even a small dip in business reinvestment or pay growth can hit household stability hard. So while corporation tax may look like a change aimed at boardrooms, its true impact spreads far wider. In 2025, expect this tax hike to play a hidden but powerful role in shaping the prices you pay and the financial decisions your employer makes. The tax changes coming in 2025 aren't just lines in a government budget, they're direct hits to your income, your savings, your future. From silent threshold freezes to invisible allowance cuts, the system is shifting beneath your feet. And most people won't notice until they feel the financial pinch. What looks like a small policy tweak on paper can mean hundreds or even thousands less in your pocket. Whether you're an employee, investor, freelancer, or just trying to build a secure future, these changes matter. But here's the truth. Knowledge is your best defense. Understanding where your money is going is the first step to protecting it. It's time to question what you've been told, calculate what's really yours, and start planning smarter. We'd love to hear from you. Which of these tax changes worries you the most? Or have you already started adjusting your finances to prepare? Drop your thoughts, strategies, or even frustrations in the comments. We read every one, and your insight helps others too. And if this video opened your eyes, you'll definitely want to check out our previous breakdown on inflation-proofing your income. There's a ton of value there to help you stay one step ahead. Creating these videos takes hours of research, scripting, and editing, all to bring you content that's not only informative, but potentially life-changing. So please, if you found this useful, support us with one simple click. Hit that subscribe button. It might seem small, but it means the world to us and helps us keep making videos that matter. Thank you for watching, and here's to making smarter money moves in 2025 and beyond.